Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today would typically be Michael Becker, but he is on another due diligence assignment. In fact, I think he's closing either one or two transactions today. So we wish Michael and his group at SPI a lot of luck getting everything closed out on a timely basis. Thanks for joining us in the podcast today. We are going to be doing the third quarter 2018 Loan Officers Roundtable. And before we get into talking to some of the most talented loan officers in the Southwest, James, what's going on these days with the Old Capital events?
We got a couple things coming up. So number one, on Wednesday, August 1st, we're going to have Steve Brown. So he's the editor of the Dallas Morning News real estate section speaking to our group. So that's going to be 6 o'clock at the Grapevine Convention Center. And then also Thursday, September 13th, we're having our big conference at AT&T Stadium. So if you have not registered for those events, you can go to oldcapitalpodcast.com to register for those events.
Yeah, those are going to be two great events. The conference with Steve Brown at the Grapevine Convention Center, August 1st. We'll have 200-300 people in that event. That's a great opportunity to do networking. And Steve, who's written for the last 40 years in the real estate section for the Dallas Morning News, does a great job of explaining a little bit about what's going on. I also didn't want to forget August the 16th up in Northern California. We're going to take the road show of the Old Capital Podcast on the road up in San Jose. So go on to the oldcapitalpodcast.com website and register for the kind of the meetup in Northern California. JC Castillo, Brad Summerk, myself. The speakers this month are going to be Michael Becker. He actually is going to be in Northern California. He's going to get on a jet travel up to see all of our friends, our software engineers, and the people in the Silicon Valley, to have people understand a little bit about what Michael does and what it's like to invest in Texas. It'll be a great opportunity for people to get together. So go to the Old Capital Podcast. Also to August the 18th, don't forget we are co-hosting the Apartment Investor National Conference, co-hosting with Brad Summerk. That's at the Hearst Convention Center. Again, great event for some networking there too. And just like James says, September 13th, get in the game. So make sure you get your tickets for that. That is selling out soon. So again, today in the podcast, we are doing the third quarter Loan Officers Roundtable. I think we have probably the most talented loan officers with a depth of knowledge on the multifamily side of any large multifamily group that does financing. I mean, I've done this for almost 35 years, close 5,700 apartment loans. James Zhang is with us today. James, how are you?
Great. Thanks for having me, Paul.
Again, Ricardo Hinojosa.
Paul, how are you?
I'm wonderful. And then Dave Walls.
Paul, good morning.
So guys, thanks for coming together. When I walk into a store, I always ask the person behind the counter, how's business? I use it as an icebreaker, but also I am generally curious about how the business is going. The person behind the counter usually has a sense on what truly is going on in their business. So I'll ask the team, how's the real estate business going? Are transactions getting done? And what should potential borrowers be aware of? So James, how's business these days?
You know, I think business has been great the last couple of years. I mean, it's been great this year. I think what we want to sort of talk about is probably leverage to start the conversation off. And so just to give you just sort of a snapshot of the DFW market, in, let's say, February, there was probably 40 deals on the market in terms of B and C deals. And almost everybody was quoting 75 to 80% leverage on those deals. And what we've seen is just that not only have prices gone up, but then Fannie Mae has become more conservative. And so in this second round of listings, let's say there's probably 10 to 15 deals on the market right now. When people are asking us for term sheets, it's very rare, if even ever, that we see 80% leverage, but closer to 70 to 75.
Yeah, that's probably two things that I would want to talk about just on my 2 cents is really things that concern us a little bit, and I want to make sure I bring that up to everybody, is pricing waivers. Pricing waivers with Fannie Mae. Again, Fannie Mae only does multifamily properties. There's Fannie Mae and there's Freddie Mac. We do a lot of business with Fannie Mae because they really support the affordable housing initiative that people, should be able to live in their property. So we do a lot of business with Fannie Mae on the multifamily side. So James, talk a little bit about what's a pricing waiver.
So a lot of times you can keep the deal delegated at just the delegated level with the DUS lender, or you can take the deal up to Fannie Mae. And when you take it up to Fannie Mae, you can ask for a couple things. And one of them is pricing waivers. Another one is interest only. And so earlier in the year, we were able to get anywhere from 20, 30 basis points off of your interest rate, in addition to a discount for green financing. So if the property qualified for green, then you would get that pricing discount on your interest rate as well. And so what we've seen in the last month or so is that Fannie Mae has become less, let's say, aggressive on those pricing waivers. And so they've pulled back on those pricing waivers as they've seen that more and more people are coming and asking for them. But then also people necessarily with not the most experience are requesting them. And so I've seen where people with probably 5-6 deals under their belt, they have a good track record. Their schedule of real estate is very strong, good cash position. They're investing a lot in these deals with their own cash. And those people are still getting pricing waivers. They're still getting the interest only. But where we've seen some pushback on pricing waivers is where there's less experienced borrowers. They might have 1 or 2 deals. They're not putting that much money in the deal, and they're getting pushback from Fannie Mae on getting these pricing waivers.
I would just say that that's totally what we're seeing, even with experienced borrowers. I just got a waiver request back this morning. Very experienced borrowing group, plenty of experience in that market, tons of liquidity, tons of net worth. We were expecting what we've seen in the past, 20 to 30 basis point waiver for this group. We got 10. Now we're going back, we're pushing a little bit. I think we probably will get it back up to 20, but the fact that they're just being a lot more conservative up front on these deals has been pretty consistent, I would say, over the last quarter.
And it also depends when you're looking at the deal is Fannie Mae is also looking at the leverage that going into the deal. And so if you are 75 to 80%, it might be harder to get the interest only and the pricing waivers. But if you are lower leverage, they've been a little bit more nice to you, I guess, on those.
That definitely dovetails into my second concern is really what's the difference between getting issued a term sheet at the beginning from your lender versus what the actual loan commitment is right before you close. So let's talk a little bit about that and some of the concerns that we're seeing right now.
So in terms of process, a lot of people will get to know us. They'll reach out to our group for a term sheet. And we essentially take the deal, underwrite the T12 rent roll, and we'll issue you a term sheet based on the best loan terms that we're seeing after underwriting the deal. So for example, someone brought us a deal and they were looking at paying approximately, let's say $29 million for the deal. And we gave them a term sheet for 21 to 22 million, 21 and a half in that range. And then, so they were fine with the deal. We underwrote it pretty conservatively. And then, they made it to best and final and they got a term sheet for 24 million.
From somebody else.
And so they came back to us and said, what's the difference? I'm losing $2 million here. And what you really have to understand about these term sheets is almost every Fannie Mae lender has almost the same guidelines, right? In terms of how they size the loan, in terms of the debt service they need to get to. And so it's really coming down to how aggressive they want to be on the net rental income, but then also the expenses in the deal. And the biggest expense right now that is the wild card is real estate taxes. So when we dug into the numbers and compared our real estate tax number to theirs, it really came down to they were using closer to 60% of the purchase price as the assessed value times the tax rate to come up with the real estate taxes, where we were using closer to 75%. And 75 is what lenders and Fannie Mae have been, that's almost where they're benchmarking, if not higher. So if the property is already assessed for 75, 80, 85%, they are not reassessing taxes. But if in some of these counties in Texas, they've been slower to adjust, but there is no cap on these assessed values. So one day it can be $10 million, the next day it could be $20 million on your assessed value, and that can dramatically impact your cash flows. And so what we've seen is these lenders have looked at transactions in that county and said, all right, these guys bought it in 2017 for X. Now in 2018, what are they getting assessed for? So they have the data. They know what these counties are coming back at, and that's what they are underwriting. And so in this situation where it was $24 million versus $22 million, the taxes were $100,000 difference on NOI. And so that was driving that loan amount. And so the buyer could take that term sheet of $24 million and go into the deal and pay, instead of $29 million, maybe they're paying $30 now with that $24 million term sheet. But then if that loan commitment comes back and Fannie says, well, I still want to underwrite 75%, all of a sudden you have a $2 million loan cut. And at that point in the transaction, especially deals in DFW, your earnest money's hard. You're already, probably 25, 30 days into the transaction, and you need to go raise $2 million.
The point I think of that story is there's real term sheets and then there's fantasy term sheets. And a lot of lenders that we're seeing in the space right now are offering fantasy term sheets because they're really not underwriting the deals. They're just taking the raw numbers, and then they may not even put them in a sizer to kind of figure out what's going on, but they're putting in, probably trying to get the green program for one, trying to get a waiver of pricing. And if they can't get it, they're going to be up another 25, 30, 40 basis points higher than what they had put out there.
And one more thing, a lot of times on these term sheets, it is based on somebody having the best experience, the best net worth and liquidity, the best every single thing. So it's assuming a lot of these items. And so if you are first or second time investor, you cannot just pick up a term sheet from anybody.
That's a great point.
And just say, well, I thought I was getting 5 years IO also. It's very dependent on the strength of the borrower's group and then what the price ends up being. A lot of times these term sheets are created, when the deal is listed at a certain price. And then as the price grows through the process of call for offers and best and final, the property really didn't change in 1 month. And so the cash flows haven't changed. And so the debt quote is not going to increase all of a sudden $400,000 because your price increased $500.
Ricardo, you've had some issues recently concerning fantasy term sheets to real term sheets, and also to what the property itself has done since the period of time that they originally looked at the deal.
Yeah, definitely. So we see this often, and one of the things that we kind of pride ourselves in, to James's point earlier, is making sure our investors understand reality going in. And part of that is also understanding what could happen between now, let's say you're going into best and final, then you go into escrow and close. So what can happen between now and then, and understanding, the what ifs, the sensitivities. I'm in the middle of one deal right now where we have a borrower that going into the deal, property was performing very nicely. So when we're underwriting these deals, we look at debt service coverage and in-place income. So we look at a T3 on the income. And going into this deal, you had 3 kind of months that were on the upward trend. So 2 solid months. Going into best and final, we had a down month. So we get a new T12 from the seller, and rental income is down. I think the high month was about $140,000 on net rental income. It goes down to about $135,000. And it doesn't sound like a lot, but when you extrapolate that into times 12,
right,
it has a big impact. And just because of that, our loan amount got cut from, let's say, I think it was $11.7 million down to about $11.4 just with that 1 month. But then you've got to assume, okay, between now and close, we're going to have 2 more months. We're going to have July and we're going to have August that are going to come in. And if for some reason those months are not back up, that good month is going to roll off, and you could potentially have 3 down months. And digging into the numbers, we found that would generate a loan cut of $700,000 to $1 million just because of that.
We're not going the right way, Ricardo.
Exactly. So you've got to know that going in, and you've got to be prepared for scenarios like that. So us kind of spending time with investors up front, understanding what those sensitivities look like, I think is key, because you've got to go in well capitalized. You've got to go in with good assumptions on what could happen. So the solution was our buyer said, hey, I've got to see July. Give me a good feel for what July is going to be, and give me an indication on August, and then give me an extension on the back end of the contract, just in case these numbers don't pan out.
Right.
That we've got time to adjust, and we've got some flexibility in the deal.
Yeah, the seller wants to get paid, wants to sell this property and gets paid. So it's worth him or her who own the property to extend out the buyer's contract so they can keep their foot on the gas. But sometimes on the short-term basis, they forget that this property is going through underwriting every month. They just don't look at the front end. They look at it in the middle, at the end, right before we close. They want to find out what's going on. So remember to if you're a seller, incentivize your team to keep their eye on the ball, to continue to do better numbers every month going up. Yeah. Anything else to add with that?
No, I mean, we'll see how this deal works out, but things are looking good. I think they're going under contract today.
Oh, great.
They got July numbers. So the buyers is decide, hey, we're going to pay this premium that it takes to win the deal. And the seller realizes that, and they're being as flexible as they can to make the deal work.
Yeah. Any solutions, James?
Well, yeah, I mean, right now in today's market, just because of the demand from buyers, you're still having to go hard day one. And so that takes a lot of your negotiation power once you sign the contract. But one more thing sort of in that sort of day 1 to day 60 that if you can get it is loss runs. What we've seen is almost every term sheet that we are underwriting, people are using insurance of anywhere from $250 to $300 a door here in Dallas. And then day 2, after they put $500,000 day 1, they get a loss run that says, well, we had a hail claim and a slip and fall and there's an open case. And then people are not getting insurance at that number.
So what is a loss run?
So it basically takes your last 5 years and any insurance claims on that property are on those loss runs. So if the seller has owned the property the entire time, then they will provide 5 years of loss runs. But if they've only owned it for 2 years, they'll provide those 2 years.
So one of the things that I have found that if one fire doesn't really change your cost for your insurance, but if you have a fire and then possibly a hail claim, you could go from making $250 or $300 a door in annual insurance cost to $700 a door for annual insurance. So get that information up front, because what type of an impact can $700 versus say $300 have on the property?
It might reduce your loan by another $500,000. So you got and then Fannie Mae is underwriting to your actual insurance. So there's no pro forma insurance. They're going to use the actual number. So you're going to have to actually get a quote and get it approved.
And talking about expenses these days, Dave, what's going on with expenses that we're looking at for, say, property taxes?
Well, just further to what James was talking about before, particularly in Texas and some of the markets such as, say, Austin, San Antonio, San Marcos, the counties are getting extremely aggressive in keeping up with values. So even when we had the typical sizing based on, say, 75 to 80% of the property's value for Fannie Mae and Freddie Mac to evaluate the NOI and loan proceeds, what we're finding now is we need to be up at 85 to 90% of the purchase price at that stage and working out the potential property taxes, because we've had a few deals lately where they've gone in at 80%, and then once the appraiser's gone out there, he has to justify all the expenses, and lo and behold, we've had to gain another 10% of property taxes onto the NOI. And I tell you, on some deals, that's equivalent to $400,000 to $500,000 in loan proceeds because of the difference in the perception of property taxes. So especially in some of the counties where they're aggressive, you've got to make sure that you put a realistic number in when you're doing your initial sizing on property taxes, because it can cost you a lot of money. And just further to that as well, I mean, we know the market's still very tight at the moment. People want to win deals. They want to get as much leverage as they can. So subsequently, they're wanting to put in their initial budget to Fannie Mae so that we can get the sizing done. And, the budget, we always tell people you've got to be realistic. But at the same time, the tendency is to try and skinny up a little bit too much so that you can get more loan proceeds. But at the end of the day, that can come back and bite you when the appraiser has his final say and we see the final numbers, and we can easily wipe loan proceeds once we're starting to argue with the appraiser and Fannie Mae. James?
Yeah, so say on some of those deals, if Fannie Mae cuts the loan proceeds, and then are some buyers taking bridge loans? or are other people recommending bridge loans in that case?
Well, here's what's happening lately. I mean, I've had 2 deals. Some of my clients have lost deals to other buyers because the seller has seen my guy come in with a pre-approval for an agency loan, Fannie or Freddie, but he has taken the other buyer that's got a bridge loan because he feels that the bridge loan is going to have less risk for going south once it goes under contract. And so it was interesting.
What's their thinking on that? Why?
Because it's no secret that rates have gone up. We're in a little bit of a volatile 10-year Treasury environment at the moment. So therefore, a seller, especially you guys that have been around the block a few times, they know that a guy goes under contract with the Fannie Mae loan, rates go up, things change, there's more risk, so the deal could go south, and he's lost out on a potential buyer when the transaction goes south. So he looks at another buyer that's got a bridge loan where it's going to close more quickly, there's going to be less interest rate risk because he's been quoted a rate right up front, and that's what it is. And so he perceives that as less risk, so he'll pick that buyer over my Fannie Mae guy. So that's kind of essentially, it's a perception of risk from the seller.
James, what do you think about bridge loans right now in this part of the cycle?
Well, the hard thing is really 2 types of bridge loans. One is a recourse bank loan on deals probably under $5 million, and then there's the non-recourse bridge loans above $5 million. And so on the recourse bank loans, we're seeing interest rates at probably 5.25 to 5.5, and that gives you 5 years, and you better fix the property in that time frame, and you got to refinance in that time. So that's usually a fixed rate. So if you do a recourse bank loan, it'll be fixed rate on those terms. But then if it's above $5 million, let's say that example of a $10 million loan, you probably don't want to go out and sign a recourse bank loan for $10 million. So you might go get a non-recourse. And so those are typically even shorter term. So those are probably 2 years interest only. And then the rate might be floating. And so on those deals, your time frame is compressed significantly. And a lot of times they will give you more leverage. So let's say Fannie was sizing to 70% loan to cost. They might give you 75% or even 80% loan to cost. And then once you've done your rehab, the problem is if you are in a bridge loan like that, you have 2 years. If there's any softness in the market and that maturity comes up, it will be very difficult to refinance, and you might have to go back to your investors to ask for more capital.
Yes. Yeah. So that is definitely a problem is that I've seen for the last, say, 2 cycles, is that these property prices have gone up so much that the NOI is just not there. And we're in a competitive market environment that people are still trying to buy apartment buildings. And they're thinking that if Fannie's at, say, 60 or 65, maybe I can go to a bridge at 70 or 75 to get higher proceeds. And it may be possible. I think one of the things that my advice is to you, and again, we did about $250 million worth of bridge financing last year, and that was last year, but now this is a whole new environment this year. We're in the later stages of this expansion of multifamily and the golden age of apartments, as Michael Becker says. I would not go with high leverage for multifamily lending on bridge lending. If you're trying to get up to 75, above 75 or even 80%, it's just that you have to bet that, say, 35 things go right in your execution of rehabbing the property, and cap rates continue to compress and rents continue to go up and the market stays the same and no interest rates don't go up from, say, 4 3/4 up to, say, 6%. So there's a lot of things that have to go right. There's only one thing that has to go wrong in that deal, and that's the whole market falls apart and lending collapses. So right now, my suggestion really is that if you can, and if it works, go with lower leverage on a bridge loan for one, or bring in more equity to try to do maybe a Fannie Mae loan in the deal. I would say equity is cheaper right now than debt, unless you're paying a preferred rate of return to your investors. And so I do have a concern with that. If someone is a sponsor trying to put together a transaction and they're throwing out a carrot that they're going to pay you 8 or 9% as a preferred rate of return, but if you just take a look at their underwriting, that they're only getting 5% cash on cash, those numbers don't work. And if the market goes even softer and it goes from 5% to 2% or even a negative rate of return on the deal, and you're in one of these bridge loans, you're going to have make at some period of time a capital call back to your investors to bail yourself out of a loan that has a quick maturity. 24 months is a blink of an eye on some of these bridge loans and that are done on debt funds. And so I'm not a big believer of going with high leverage bridge lending. 70, 75 is probably the max. Bring in some additional equity to get these deals done and kind of set it and forget it.
So we've seen dark clouds, I guess, and I'm going to bring some sunshine now to the conversation.
All right.
People are still buying deals.
Yeah.
And, job growth, the population growth, everything that everyone likes about apartments, the tax advantages, all those things, the cash flow, all those things are still why people are in apartments. And so yesterday we had a panel with 4 guys who manage probably 100,000 units across the 4 of them. And we sat down with them for an hour just to talk about the state of the market and what they're seeing. And so I just wanted to highlight 2 or 3 things.
I thought that was a great lunch and learn that you put on, James, here in the Dallas-Fort Worth area. If anybody has a chance to go to any of our events, these lunch and learns are great because we bring in great speakers. And again, you had 4 panelists that own property management companies that only specifically do apartments, and they manage 100,000 doors.
About 100,000.
I mean,
15 to 20 for each one of them. It's a good
amazing.
amount.
It's amazing.
So if you actually go to our Facebook page, the Old Capital Facebook page, it has the whole video on there if you want to watch it. But I want to highlight 3 things that I thought were key. And number 1 was payroll. And a lot of time from the lending side, when you're doing spreadsheets, you are trying to underwrite the skinniest number on payroll. And what they have seen, and someone from the audience actually asked this question, was, what are you seeing year over year in terms of payroll increases? And what they were seeing is that it's probably gone up 3, 4, 5% year over year, and that continues. And especially when unemployment is 3 or 4%, it is a battle for talent. And so you are putting this property manager in charge of a $5, $10, $15 million asset, and you're trying to pay her $13, $14 an hour. And the difference in payroll from $1,000 a unit to $1,100 a unit is important for your loan, but then also, these guys are managing the entire property. So take that in consideration when you are building out your budget for payroll, because they're running the whole ship. Number 2 is on technology. And so a lot of, on the BNC side, they're trying to take almost everything to apps or online. And so number 1, your web presence for your property needs to be good. Almost everybody is trying to get all their tenants to pay rent online. And then also there's a lot of apps out there now for leak detection, and then also for maintenance and how you manage those issues. So these are some of the advantages of going with a third-party property management company, is that they already have the systems built in. So you're stepping in and you're gaining all that knowledge, and you are paying them a management fee, but it is taking their specialty and really utilizing that versus you trying to be the property manager. And the third thing was a question around, I asked them, what is the common characteristic that you see across successful investors? And one of the property managers gave an example of, we have some owners that are way too involved, as in they're sitting in the leasing office and asking the leasing manager, every question in the book. And then there's some people who just throw them the keys and say, see ya, I'm going on my boat and I'm not going to see the deal for 10 years. So right in the middle, in terms of involvement, they still need a second pair of eyes to look at these deals, and you need to be reviewing your financial statements, visiting the property maybe monthly at the beginning while the rehab's going on, and then maybe quarterly after that to keep an eye on these things. And so
that's a great suggestion.
Yeah, it's just you are employing these guys to manage the asset, but then you are the asset manager. And so that was the key thing, was that they want to work with you, but they don't want 10 calls from you a day.
That's great. All right, guys, a potpourri. What else is going on out there that we need to know about? Dave, anything going on on the Freddie Mac small balance side that you thought was interesting, or anything else that you think is something that people should know?
A couple of things. Fannie Mae is starting to tighten up, especially on some of the tertiary student markets, particularly in Texas. They see a lot of increased exposure in these areas, a lot of new product coming on the market. So therefore, a lot of these markets, for example, College Station is one example, where instead of the loan going to a delegated, a DUS lender and being underwritten, it has to go for a pre-review. In other words, particularly if you haven't had any experience in that area, you haven't owned any prior properties in those tertiary student areas, the deal has to go to Fannie Mae right up front for a pre-review. So that's just one thing to take into account.
Yeah, let's talk a little bit about that. So Bryan College Station is where Texas A&M is, and if you've ever been down there recently in the last year or two or three, you've noticed a huge amount of student housing that's being built down there, almost to the point that it's overbuilding. There's almost too much inventory. We're starting to see that on a lot. The floodgates have been open for the last couple of years. Not only Texas A&M, but also universities like University of Missouri, Mizzou.
Correct.
Has the same kind of issue that a lot of private developers have come in there and put a lot of student housing into that area. One of the concerns also is Texas Tech out in Lubbock. That's not so much like College Station, but there is a concern about overbuilding in some of these university towns, and it's just not the student housing, but it's also market rate housing too.
Correct.
So one of the things that they're doing is a kind of a lever is instead of having us review it, it has to be reviewed by Fannie Mae directly to figure out if you have enough strength to get into that area. That's huge competition. In fact, you had a borrower just last week or 2 weeks ago that was trying to get into that College Station market, right? Was that
correct, Paul? They did, and on paper it looked like it was a viable deal. But once we dug into it, got into the numbers, he was trying to slip in just below, the brand new Class A product, but be above the kind of existing B product, and he felt he had a niche. But the issues we had was it was still going to be extremely tight with what he had to spend to bring that property to that level. And secondly, the big concern is once all this new product comes on the market and they're all trying to compete with each other in another year to 18 months, well, have it gets what? They'll probably be offering concessions, so they'll start stealing away your tenants. So it's a big risk.
Yeah, that's why they want to make sure that the person who's buying into that marketplace knows what the hell they're doing and can maybe afford to go through some dips of income during that period of time. Anything else, Dave?
Just a little bit of an update on Freddie Mac, on the Freddie Mac small balance loan side. This has not actually been formalized yet, but it's coming down the road, and that is changing their scattered site policy. In the past, you were able to buy, say, for example, you had a group of fourplexes, in other words, under 5 units, which normally have to be done by a normal residential loan scenario. Mm-hmm. Well, you had the ability to buy, say, a bunch of fourplexes as long as they're all connected, contiguous. In other words, all the lots joined up. There was nothing in between. And you could get a blanket loan, if you like, over those 4 or 5 different properties, even if they were 3plexes or 4plexes, and get a Freddie Mac loan. Well, what they're doing now is they're actually changing that scattered site policy where these 4plexes or 3plexes don't have to be connected. In other words, you could have, within a 5-mile radius, you could have a dozen, say, 4plex properties or 3plex properties, and as long as obviously they met the income criteria and you're qualified, they will consider these for a blanket Freddie Mac loan, which is, could be a great advantage to some
What's
buyers.
the minimum loan size on that?
$1 million.
So probably closer to about $1 million plus $2 million. That would probably work.
Exactly. You've got to have $1 million loan lying in there somewhere. So, but that could be a great advantage for some potential buyers and investors out there.
Great, Ricardo. Any potpourri of things that everybody needs to know about?
One more thing on the student housing I wanted to touch on. Student housing to me is a completely different animal than market rate.
Absolutely.
And if you're going to step into that box, you better know what you're doing, because when I was an underwriter back at GE, just to give you an example, we financed a deal over on Riverside, which is sort of 15 minutes south of campus. And we also financed a deal on West Campus, which is walking distance. And when the recession hit, everybody dropped their rents in West Campus, and everybody in Riverside suffered that they had to go to 9-month leases. They had to give every concession that they could think of to lease up. And we basically underwrote the deal at 95% occupied. But the problem is in the summer, it drops to 50. And so for 3 months, you suffer. And so the pre-lease cycle is when you buy a deal. Let's say you buy a deal right now, and you're not pre-leased. So like you buy a deal in August and you're not pre-leased for the next year, nobody's coming in the door. So that pre-lease cycle is very important in those student housing markets.
And one thing to add to that, Fannie Mae, they always have been, and even more stricter on student housing experience. You might own 10,000 units in a normal domestic residential market, non-student market, and you want to go and buy yourself a student property, and you might have 5 years, 10 years, 15 years of experience. Well, have a guess what? Your current property manager, you probably have your own property management company if you're that big. You may not necessarily be able to manage that student housing deal that you're going to buy. So Fannie will probably make you get in at least a third-party experienced property manager in student housing. In other words, they want to see student housing experience from day one.
Let's go. You have the microphone. What else is going on?
So one more thing is that as people have bought more and more deals in this cycle, the last 2 or 3 years, their schedule of real estate has grown, which has helped, their net worth and liquidity. But one thing to consider is now when you're going in for loan approval, just like you have in the past, you provide your personal financial statement, you provide your schedule of real estate. They are looking very detailed at that schedule of real estate. And so they are looking at your debt service coverage, they're looking at your leverage, they're looking even at your rehab budgets on these deals and saying, well, you said you were going to do $500,000 and you've only done $250,000. How come you're not done? You said you were going to be done in a year, and now it's 2 years into the deal. And so your performance on your portfolio, your existing portfolio, is very important, especially as you go and you build a loan book, or you have all these loans outstanding with Fannie Mae. They go through and they get reports quarterly from these DUS lenders. So you need to make sure that your portfolio is in good shape. And when the underwriter comes and takes a look at your property that you're buying, they might also be driving by the other 3 or 4 in that market that you own. And so not only for your investors, but then also as you buy more and more deals, you can't take your eye off the ball of your current portfolio, because we've had key principals and also sponsors have to give T12s and rent rolls on other deals that they're not even buying right now. It's just in their portfolio. Fannie Mae is asking for updates on those deals.
Yeah, there's a little thing called a computer, and everybody is connected these days. I'm going to jump over to Ricardo just for a second, but I want to kind of touch upon a lot of these folks to get their Fannie Mae Country Club card or their visa to get into the Fannie Mae Club. They signed on other people's transactions. Talk a little bit about that and the repercussions it could have.
So it is a benefit, right? So it is a benefit that you did sign on a loan, but a lot of people ask us, what's the risk? And the risk is if that deal starts going sideways and you're not even the manager, you're just the key principal, but you have to show it on your schedule of real estate, and you're holding up that property as if this is the property that you have all the experience on, and now you go and do your own deal. When you take it in the Fannie Mae, they're going to look at that one property and they're going to ask you how that deal is performing, and they have the numbers. So you can't fudge the numbers. They have the numbers. It's reported to the lender quarterly. So you better make sure that any deal you sign on, you believe in.
Not only do you believe in, but if you're trying to get to do a deal yourself, and that property that you signed on 2 years ago is not performing, it could have an impact on the deal that you want to try to do yourself.
Right. So the pricing waivers might be gone, the IO might be gone, and the leverage might be reduced.
Yeah. So pay attention to that. Ricardo, anything more?
No, I was going to highlight some of that, but I think the overall theme, what we come back to a lot, is make sure you're leveraging your team now more than ever, and that you're leveraging them early in the process.
At what period of time should somebody call Old Capital? That's a question that I get every day. Yeah. Is that I found a property, now I'm trying to get financing on it, or should I try to get pre-approved first? And really, what does that mean?
Yeah, I tell our investors, engage us when you start looking at a deal. Hey, to understand whether or not it makes sense, the financing is a lot of times going to determine whether or not it makes sense for you.
Right.
So don't take these, the term sheets that you get sometimes in OMs, or they're just passed out. Like James mentioned earlier, they're just kind of template max, hey, best case scenario term sheets. don't take that as gospel. You got to reach out to us. We got to understand you, what your experience is, and then we got to look at the property and truly underwrite it, and we'll give you a good feel for it.
That's great. I mean, that's exactly it. And don't forget, in these multifamily transactions, 65% of the approval is based on the property. The rest is kind of based on you and the team that you assemble to take the deal down and the amount of equity that you're going to be able to raise. So always call somebody at Old Capital to be a partner with you to make sure that you're looking at these deals correctly. Because if this is your first deal, it's the most difficult one is go from 0 to 1. Have some experience on your side to make sure that you're making the right decision. A deal that I saw yesterday, somebody from San Jose looking to try to buy a property in Atlanta. 40 doors in Atlanta. They live in San Jose. They're software engineers trying to buy a property, 40 doors in Atlanta. I was like, have you been to Atlanta? No, we're going to go. We're going to go there. But I want to make I want to do an LOI on the deal. Have you talked with a property management firm? No, we're going to do that. Do you have any idea what the rehab is going to be in the deal? No, we're going to look at that. So these are things that we're going to kind of coach and counsel you on to make sure that you kind of understand what the order of events are to put it together. Anything more, Dave?
Yeah, further to that, Paul, I mean, one of the things that we do, and I'm a big advocate for this, is a business plan. It doesn't matter how big or how small. I encourage all my clients to put together a business plan. It does two things. Number one, it makes you think about the deal. Put together a detailed business plan. Why you're buying it, what are the ups, what are the downs, pros and cons, pro forma expenses, comps, and it makes you think about the deal, but also impresses the lender. If he sees a business plan, and especially if you're a first-time buyer into this market, it just adds a lot of weight and a lot of credibility in front of a bank that we'd present the deal to.
All right. So I've been Debbie Downer. Let's end with James. Any other positive things you can say in the market right now?
No, I mean, I think everybody, especially here in Texas, the jobs, the population, just they're still seeing rent growth, especially in the B and C space. I mean, I think there's still relative value in investing in multifamily, and that's why the demand is still there. I mean, there's still 10 to 15 people bidding on these deals, and there's still money to be made. I mean, I think Dotzer said these tax changes, the ability to do bonus depreciation and just take some of these losses in year one is probably going to extend this thing a couple of years.
Yeah.
And so there's still a ton of advantage of multifamily, and we're here to help you.
But meet the right people. Meet the right people. Come to the Old Capital Multifamily Conference on September 13th. These are the people that are in the business. Start your foot in the right direction. I mean, we're going to have 500-600 folks at this meeting, other equity investors, other principals, but a lot of the vendors, the people that are actually in the business, the listing agents, the top 5-6 listing agents in the country will be here, and this is the people you really want to get to know a little bit better. Boy, you guys are the smartest people in the room today, I tell you. Usually it's Michael Becker, but it's your group. Unfortunately, we couldn't have a couple of the other loan officers from Old Capital, so we apologize for not getting those guys on. We'll get them on next time. But thanks for coming in. Ricardo Hinojosa with Old Capital up in the Frisco, Dallas area. Dave Walls with Old Capital in the Austin, San Antonio. And then James Ang, the senior loan officer for Old Capital, that the words of wisdom coming out, also works in the Dallas-Fort Worth area. So great information. We appreciate everybody listening to the podcast. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.